Investing is about making your money work for you. It's a way to put your money to good use, allowing it to grow and multiply over time. Instead of sitting in a savings account where it earns minimal interest, your money can grow faster in the market. The stock market, for instance, has historically provided higher returns. Think of it like planting a seed. Over time, it can grow into a strong tree. Just as a tree needs water and sunlight, your investments need time and the right conditions to flourish. But just like planting, investing takes some know-how. You need to understand the basics and perhaps seek advice from financial experts to make informed decisions. Mutual funds and ETFs are two popular ways to invest. They offer a way to pool your money with other investors to buy a diversified portfolio. They let you buy a basket of stocks or bonds, kind of like buying a variety pack instead of just one flavor. This diversification helps manage risk. This helps spread your risk and potentially increases your returns. By not putting all your eggs in one basket, you can better weather market fluctuations. Don't be intimidated by the fancy names. Financial terms might seem complex at first, but with a bit of study, they become easier to understand. Understanding these investment options can empower you to make smart choices for your financial future. Knowledge is power, and it can lead to better financial outcomes. Let's dive in and explore them together. The journey to growing your money starts with the first step, and we're here to guide you along the way. Mutual funds pool money from many investors to buy a diversified portfolio of stocks, bonds, or other assets. Think of it like a big pot of money that everyone contributes to, managed by a professional fund manager. These managers decide which securities to buy and sell based on the fund's investment objectives. You buy shares of the mutual fund, and your returns are based on how well the fund performs overall. Mutual funds can be a good option for beginners because they offer instant diversification and professional management. However, they often come with higher fees than ETFs. ETFs, or exchange-traded funds, are similar to mutual funds in that they offer a basket of assets. This basket can include stocks, bonds, or other types of investments, providing a diversified portfolio. But unlike mutual funds, ETFs trade on stock exchanges just like individual stocks. This means they can be bought and sold throughout the trading day at market prices. This intraday trading capability allows investors to react quickly to market changes, buying or selling ETFs just as they would with company shares, providing greater flexibility. ETFs typically track a specific market index, such as the S&P 500, the NASDAQ, or other indices. This means the ETF aims to mirror the performance of that index, offering a way to invest in the overall market or a specific segment of it. This makes them a straightforward and efficient way to invest in a broad market sector or theme without having to pick individual stocks. ETFs are also known for their lower fees compared to mutual funds, as well as their flexibility. This cost efficiency makes them attractive to both novice and seasoned investors looking to maximize returns. However, it's crucial to understand the index or sector an ETF tracks before investing. Knowing what the ETF is composed of and how it aligns with your investment goals is essential for making informed decisions. Mutual funds offer a hassle-free approach for beginners. With a single purchase, you gain exposure to a variety of assets, providing instant diversification. This mitigates risk by not putting all your eggs in one basket. Professional management is another advantage. Fund managers make investment decisions on your behalf, leveraging their expertise to potentially maximize returns. This hands-off approach frees you from constant market monitoring. Furthermore, mutual funds often provide features like automatic reinvestment of dividends, simplifying the process of compounding your returns over time. Section 5. ETF advantages, flexibility, and transparency. ETFs win points for flexibility. Traded like stocks, they offer intraday trading, allowing you to react to market movements in real time. This feature makes ETFs suitable for active traders or those seeking tactical exposure to specific market segments. ETFs are known for their transparency. Their holdings are typically disclosed daily, providing clear insight into your investments. This transparency allows for greater control and understanding compared to some mutual funds that disclose holdings less frequently. Additionally, the fee structure of ETFs, often lower than mutual funds, can contribute to higher net returns over time. This cost-effectiveness has contributed to the growing popularity of ETFs. Section 6. Making the choice factors to consider. When deciding between a mutual fund and an ETF, Consider your investment goals, risk tolerance, and how actively you want to manage your portfolio. Think about your investment style. Are you a buy and hold investor content with long-term growth? Mutual funds might be a good fit. Prefer more control and the ability to react to market changes? ETFs could be more your speed. Fees matter. Compare expense ratios, the annual fee charged to manage the fund, as lower costs can significantly impact your returns over time. Section 7. Finding the right fit for your investment journey. Choosing the right investment is like picking the right tool for a job. Each tool has its own purpose and function, and the same goes for investment options. Both mutual funds and ETFs can be valuable additions to your financial toolbox, each with its own strengths and unique features that cater to different investment strategies. Mutual funds, with their simplicity and professional management, can be a great starting point for new investors. They are managed by professionals who make the investment decisions for you. They offer a hassle-free way to gain exposure to a diversified portfolio without needing to pick individual stocks. This diversification helps in spreading risk across various assets. ETFs, on the other hand, appeal to those who prefer more control and flexibility. They can be bought and sold like individual stocks throughout the trading day. Their intraday trading and typically lower fees make them attractive for active traders and cost-conscious investors. ETFs often have lower expense ratios compared to mutual funds. Before investing in any fund or ETF, do your homework. Research is crucial to understand what you are getting into. Understand its investment objectives, fees, and risks. Each investment comes with its own set of risks and potential rewards, and if you're ever unsure, don't hesitate to seek advice from a trusted financial advisor. They can provide personalized guidance tailored to your financial goals and risk tolerance. Section 8. Invest smart, live better. Understanding the differences between mutual funds and ETFs empowers you to make informed decisions about your financial future. Remember, investing isn't about getting rich quick. It's about building wealth steadily over time. Whether you choose the ease of mutual funds or the agility of ETFs, the key is to start investing early and consistently. The magic of compounding earning returns on your returns works best over the long haul. So take control of your financial well-being. Explore your options, invest wisely, and watch your money grow, paving the way for a brighter and more secure future.